The bomb didn't detonate in Washington, D.C. or Beijing. It exploded inside China's interbank market. Morgan Stanley, the fifth largest U.S. bank by assets, borrowed money last week, not in dollars, in yuan, on Chinese soil with Chinese investors, using a Chinese system that bypasses the entire American financial order. Not a hedge, not a test. A $278 million yuan-denominated panda bond issued, cleared, and approved by the very government Trump labeled a currency manipulator. And this isn't theory. This is America's own Wall Street mutinying against its own currency. And it came hours after the U.S. Treasury admitted it was wrong again. Net borrowing for the third quarter was revised up, not by a little, by $453 billion. Total for the quarter, $1.007 trillion. That's $1 trillion just to keep the machine breathing. Two headlines, one story. The dollar isn't collapsing, it's being traded around by its own. Because as Morgan Stanley takes yuan capital to fund offshore operations, the Federal Reserve faces a different fire. Global dollar reserves just hit 58%, the lowest since records began, down from 73% in 2001. And this isn't a temporary dip. It's a 23-year rejection. And here's the twist. It's not being led by adversaries. It's being led by allies. The top sellers of U.S. Treasuries in 2025, Japan, Switzerland, Canada. Countries that supposedly trust America the most are quietly reducing exposure to its deepest financial instrument. And they're not even hiding it. According to Bloomberg, Japanese holdings of U.S. debt dropped by $54 billion in the first half of 2025. Switzerland cut $22 billion. Even Norway trimmed 11%. But here's where it spirals. Because while America is losing buyers, China is building them. Not politically, financially. Hungary issued a 5-year yuan bond this summer, the first of its kind from a European government. South Korea followed. Poland joined. Then came Mercedes-Benz, BMW, Volkswagen, Canada's national bank. They're not just exporting to China, they're borrowing from it. The panda bond market has ballooned to over $15.5 billion in 2025 alone, up from $7 billion last year. And according to the Financial Times, over half the participants are now from outside Asia. The West is tapping the yuan faster than Washington can explain it. Why? Because U.S. borrowing costs are toxic. According to Moody's, the average yield for new U.S. corporate bonds exceeds 5.5%. Treasury yields have topped 4.8%. Meanwhile, Morgan Stanley borrowed in China for 1.98%. That's not just a better deal, that's a different planet. And the cause? Inflation. But not just inflation, weaponized inflation. Because while the Fed raised rates to control prices, Trump weaponized tariffs to create new ones. Since retaking office, the average U.S. tariff rate has crossed 13%, the highest in 90 years. The logic? Punish imports. The result? Inflationary shock. The U.S. Producer Price Index for intermediate goods rose 7.1% year-on-year. Food inflation is still above 5%. Gasoline is up 5% in 6 months. And what's the backup plan? Apparently, it's to threaten the world's second largest oil producer. 10 days. That's the deadline Trump gave Russia. If no progress is made on Ukraine peace talks, the United States will sanction any country buying Russian oil. Let's pause. Because this wasn't supposed to happen. You don't burn the bridge while you're still standing on it. Yet that's exactly what happened. Trump threatened the energy supply of half the planet, while the U.S. economy is still choking on interest rate fumes. Crude prices spiked 3.5% instantly. Brent shot past $72 a barrel. And with it, inflation expectations surged. The bond market reacted immediately. 10-year yields jumped 14 basis points in a day. The Fed's forward guidance collapsed. Powell is stuck between defending the dollar or tanking the economy. He can't do both. And while the White House framed it as tough love, the market saw it differently. BlackRock's global macro strategist Ben Powell said it plainly, "You don't threaten your trading partners in a fragile supply chain environment unless you're out of options." But Russia didn't blink because it doesn't need the U.S. market anymore. Not when it has India, China, Brazil, and now, astonishingly, Japan. Reuters confirmed that Japanese refiners, despite G7 sanctions, have resumed small-scale Russian crude purchases via third-party shipping. Payments are being routed through the Mir system, settled in yuan or rupees. In India, they just signed a $45 billion long-term oil deal with Russia, bypassing SWIFT entirely. That's not defiance, that's evolution. And Washington's leverage? It's becoming bluffable. But even more devastating than lost leverage is lost belief. And the trade deal with Japan exposed just how hollow America's economic diplomacy has become. In July, Trump stood at a podium and declared a victory, a $550 billion Japanese investment in the United States, a down payment, a signing bonus, a restoration of faith, until Tokyo corrected him. According to Japan's Ministry of Economy, Trade, and Industry, less than 2% of that deal, around $11 billion, is actual investment. The rest, low-interest loans, structured debt, most not even approved yet. Worse, Trump claimed 90% of profits would go to American firms. But Japanese negotiators clarified that this only applied to certain cooperative ventures, not the big projects, not the infrastructure pipelines, just the crumbs. End of the punchline. Japan explicitly stated the United States will not receive $550 billion in cash. So what did America get? A headline. And what did Japan get? Political coverage. U.S. access. A trade corridor into Mexico. That's not a deal. That's a diplomatic judo throw. Through the first 8 months of 2025, the federal government has already racked up a $1.4 trillion deficit. Add the $1 trillion the U.S. Treasury needs to borrow through September, and we're staring at a projected $2.4 trillion deficit, more than 8% of GDP. But here's the twist. This borrowing isn't being fueled by global enthusiasm. Foreign buyers are pulling back. Domestic funds are showing resistance. The Federal Reserve is on the sidelines. And yet, the borrowing must continue. So, interest rates climb. Inflation persists. And the dollar, the supposed bedrock of the global financial system, keeps showing cracks. Meanwhile, prices rise across the board. Not just for gas or electronics. According to USDA data, beef prices are up 54% since 2022. Milk, up 23%. Eggs, 31%. Farmers are passing along the rising costs of feed, diesel, and fertilizer. And there's only one immediate political fix: subsidies. Trump has already promised them. But subsidies mean more debt, more auctions, more pressure on interest rates, and even less maneuverability for the federal. It's a self-reinforcing loop now. And that's why the Morgan Stanley bond isn't just a blip, it's a signal. It wasn't about a rate. It was a message. America's capital elite no longer see the dollar as a given. Chinese liquidity is faster, cheaper, and, most damningly, less political. Wall Street isn't alone in this shift. In July, Saudi Arabia's Public Investment Fund issued its first yuan-denominated sukuk to finance real estate projects in eastern China. In Europe, Greece's Kredia Bank raised €600 million to invest in yuan assets for cross-border settlements. The UAE Central Bank has launched direct yuan clearing operations. These aren't ideological moves, they're balance sheet decisions. And balance sheet moves rarely reverse once they begin. Even India's central bank, long cautious on de-dollarization, admitted in its July monetary report that yuan holdings now make up a record 8.3% of its foreign reserves. This isn't de-dollarization as a warning. It's de-dollarization as default behavior. At the end of July, the Bank for International Settlements issued a report that was largely ignored in Washington. It revealed that cross-border payments in non-dollar currencies are up 36% year-over-year, the largest jump since 2008. The BIS cited systemic avoidance of dollar-linked exposure by trade-heavy nations including Vietnam, Brazil, the UAE, and Singapore. Meanwhile, China's cross-border interbank payment system hit a record $430 billion in volume in June, up 65% from last year. HSBC's head of Asian FX, Ronald Mann, told the Financial Times, the yuan is now viewed not just as a hedge, but as infrastructure. In a major development, Brazil has started pricing its soy exports to China in renminbi, a direct threat to one of the last major agricultural trade bridges denominated in US dollars. Brazil's central bank reports that over 14% of its foreign reserves are now in yuan, surpassing euro holdings for the first time ever. That's not diversification. That's the dam breaking. The world is building a plan B, quietly, logically, and in plain sight. And yet the United States still acts as if it has no competition, still threatens trade partners, still celebrates hollow deals, still punishes its own consumers with structurally inflated prices. Here's the irony. The U.S. built the very tools now being used to work around it. It helped create SWIFT. It weaponized sanctions. It made the dollar universal. And now each time Washington pulls that trigger, another country starts building a workaround. That's why Morgan Stanley's bond matters. It didn't need Washington's approval. It didn't rely on the federal. It didn't come with a press release. It just happened quietly, efficiently, definitively. So here we are. One American bank borrowing in yuan. One U.S. president threatening military action to salvage trade leverage. $1 trillion debt issuance that no one wants to buy. And one question Washington refuses to ask. What happens when the rest of Wall Street joins Morgan Stanley? Because when your own banks start trusting your rival's currency more than your own, this isn't just de-dollarization. It's surrender.